Do you really think IRS doesn't know about your crypto? Think again. In 2023 alone, the IRS sent out tens of thousands of warning letters to crypto investors who didn't report their transactions. Some people have even faced criminal charges for tax evasion on crypto gains. So if you're trading, stocking, mining, or even just spending your Bitcoin, the IRS wants their cut. But here's the thing, you don't have to overpay. If you understand the rules, you can use them to your advantage and save thousands of dollars every year. In this video, I'm going to break down how crypto is taxed in the USA, the biggest mistakes that get people in trouble, and powerful strategies you can use to cut your tax bill legally. So let's dive in. How the IRS classifies crypto. Here's the most important rule. Crypto is property, not currency. That means every time you sell, trade, or spend it, you're creating a taxable event. Example, you buy Ethereum at $2,000. 6 months later, it's worth $3,000. You swapped it for Bitcoin, and boom, you just triggered a $1,000 capital gain, even though you never cashed out a dollar. The IRS made it clear, crypto-to-crypto trades are taxable. And here's the kicker. Exchanges like Coinbase, Binance.us, and Kraken now send 1099 forms directly to the IRS. So if you think they'll never find out, you're playing with fire. There are two flavors of crypto taxes you need to understand. Short-term gains. If you held your crypto less than a year, profits taxed like ordinary income. Depending on your bracket, that could be as high as 37%. And long-term gains. Hold your crypto for over a year and your tax drops to 0%, 15, or 20, depending on your income. For many investors, this can cut the tax bill in half. Holding for just few more months can literally save you thousands. If you're mining, staking, yield farming, or getting paid in crypto, that's taxable as income the day you received it. The IRS looks at the fair market value in dollars and adds it to your taxable income. For example, you mine 0.1 BTC when Bitcoin is $50,000. That's $5,000 counts as income before you even sell it. And when you eventually sell it, you may face capital gains taxes on top of that. So miners and stakers actually get taxed twice unless they plan correctly. Now let's talk about the dangerous stuff, the mistakes I see over and over again. Not reporting small transactions. Buying coffee with crypto, yes, technically it's taxable. Using DeFi wallets and thinking the IRS cannot track them? Wrong. The IRS has contracts with blockchain analytics firms that trace transactions across wallets. Forgetting about airdrops and hard forks. Even free coins count as taxable income. Mixing business and personal wallets. This makes it nearly impossible to track bases and deductions. And the IRS loves messy records. And here's the worst mistake, ignoring the tax question on front page of your 1040 form. It literally asks, did you receive, sell, or otherwise dispose any virtual currency? If you check no when you actually did, that's perjury, lying to the IRS. Now let's switch gears because there are legal ways to slash your tax bill if you are proactive. If some coins are down, you can sell them at a loss to offset your taxable gain. Unlike stocks, there are no wash sale rule yet for crypto, meaning you can sell it at a loss and immediately buy back the same coin. Simply holding for more than a year can drop your rate from 37 to as low as 0. This one strategy saves investors more money than anything else. Using a self-directed IRA or 401k, you can buy crypto and grow it tax-deferred or even tax-free in a Roth. If you're mining or staking at scale, setting up an LLC or S Corp may allow you to deduct electricity, hardware, and other expenses. This can turn your taxable income into business deduction. Donating crypto directly to a charity lets you avoid paying capital gains and take the deduction for the full fair market value. Here's what you need to remember. The IRS isn't playing anymore. They've launched Operation Hidden Treasure, a task force dedicated to finding unreported crypto. They're using AI, blockchain forensics, and data from exchanges. In some cases, they've gone after people for tax fraud with penalties of 75% of unpaid tax, and extreme cases, even prison. But the good news, if you file correctly and use the tax code to your advantage, you can protect your profit and sleep at night. Crypto has created massive opportunities, but it also comes with the tax responsibilities. And if your current CPA has no clue how to handle crypto taxes, you don't have to do it alone. Work with my team at Solution 8020 and we'll build a custom plan for you. Make sure to like this video, drop your crypto tax questions in the comments, and subscribe for more tax strategies that actually save you money. Thanks for watching, and may your gains be high and your taxes be low.